Welcome back to another episode of Sidekick TV, where we're joined by JMI Wealth's Greg McGeorge. Greg has over 35 years of experience in financial markets across London and New Zealand. And if you wish to contact Greg, his contact information will be listed wherever you see this video or audiobook. In this episode, we talk about the growth in private credit, also known as shadow banking or non-bank lending. In America, this has grown to over $1.7 trillion. To give that some reference, that's over 4 times the New Zealand economy. So stay tuned to hear more from Greg about this. So Greg, tell me, what have been the main talking points of last month?
Well, two of the most talked about topics in Feb were the stress in US commercial property loan market, and particularly those loans made to office spaces and malls. And the other big talking point was the re-emergence of inflation, and in particular the pushback from central banks to cutting interest rates and comments about potentially even increasing interest rates. But both of these topics are being well covered by local media, so I thought I'd instead talk about the rise of private credit, which has been a hot topic globally for actually quite a while now. And I did talk about it late last year, but every week it seems to be popping up in publications around the world. So private credit is basically what seems to be now fueling corporate America. And the surge in private credit marks a significant shift in the financial landscape as non-traditional banks such as hedge funds and private equity funds have increasingly become the driving force behind lending to corporate America. With interest rates and additional regulations and oversights on the traditional banks, these hedge funds and private equity firms have assumed a more dominant role in providing lending to the corporate sector in America. And this trend reflects a departure from the traditional reliance on Main Street banks for corporate lending, while with private credit emerging as an increasingly preferred option. Estimates now have the private credit market in the US at $1.7 trillion US.
Wow. So Greg, can you elaborate? What is private credit?
Yep, so as we know, Wall Street loves using jargon to make things sound sexier or more complicated than they really are. And the private credit label is no different. The name private credit simply means or describes lending that is not controlled by the traditional banks. It's been referred to as shadow banking or non-bank lending. It's as simple as that. It's lending that is not subject to the same regulatory oversight as traditional banks. In the 1980s, we had leveraged buyouts, which got a really bad name, so they rechristened it to private equity. It's the same for shadow banking or non-bank lending. We now rebranded that as private credit.
So why is it booming now?
The shift to private credit is actually a trend more than a decade in the making. Hedge funds and private equity firms have been siphoning money and talent from the banks since the regulatory crackdown on the traditional banks after the 2008 financial crisis. But activity has only significantly picked up in the last couple of years. While increasing interest rates brought down banks such as Credit Suisse and Silicon Valley last year, and at the same time forced other traditional banks to dial back their lending even further, the higher interest rates and further pullback from banks only encouraged private credit funds to step in and finance even more loans. It's that increased regulatory oversight, along with the higher returns for investors, that has helped create the boom in private credit of late. And as we know, trying to borrow funds from a bank is only getting harder and harder for companies. Corporates are instead being forced to seek out these non-bank lenders in the form of private credit funds, even if they don't want to.
Okay, and so how does it all work?
So think of your traditional managed fund. A fund manager creates a new fund and raises money from investors, but instead of buying stocks and bonds in the usual way, the fund manager will lend directly to corporates. And the other big difference is the type of investor. So this isn't a mum and dad investment vehicle, but is aimed at the insurance companies, pension funds, sovereign wealth funds, and even high net worth families. Hedge funds and private equity funds have been the main players in creating these funds. Some of the biggest players are the likes of Blackstone, KKR, and the Carlyle Group. Insurance companies, pension funds, and the sovereign wealth funds are flocking to these private credit funds. It gives them a much higher rate of return than they're currently getting on other investments. And they aren't focused on liquidity either. By that, I mean they don't actually need their money back in a hurry. They have long-term liabilities they need to fund, so they're happy to invest and have their assets tied up for a similar longer period as well. In fact, life insurance companies have proven to be such a great source of new money for these private credit funds. What with their predictable cash flows from the monthly premiums they receive, that some private equity managers have gone so far as to start buying insurance companies so that they can have guaranteed access to uninterrupted premiums, which they then obviously invest into their own private credit fund, which they then on-lend to corporate America. It's a beautiful model.
So with this growth in this sector, presumably that's taking away from the banks. What are the banks doing about it?
Yeah, absolutely right. And somewhat ironically, the banks are fighting back by, you guessed it, setting up their own private credit funds. The growth in private credit is in large part driven by the retreat of banks from commercial lending. Regulators made it more and more difficult for banks to lend out their depositors' money post GFC. So banks are now also targeting insurance companies and pension funds for their own private credit funds, which they can then on-lend to their corporate clients without the same regulatory oversight. And when you think about it, it makes sense. The banks have had a long-term relationship with these corporates, so no one is in a better position, other than the company itself, than the bank to evaluate the credit quality or the credit worthiness of these corporates that they're lending to. And some of the biggest banks in America, the likes of Wells Fargo, Citigroup, JP Morgan, are all in the process of setting up their own private credit funds. It's even spread to Europe now, where some of the biggest banks are also in the process of setting up their funds. So SocGen recently set up a 10 billion euro private credit fund. Barclays Bank in London likewise is in the process of setting up their own fund.
Is anyone concerned about this?
Yes, and for different reasons. Some market participants and regulators are sounding alarm bells about the way these private credit firms are buying insurance companies and then using those premiums to fund their private credit fund, which then on-lends to the corporates. US regulators, as recently as mid-Feb, raised concerns that the complex and opaque nature of arrangements between private equity firms and their captive insurers now means life insurance companies are effectively becoming the new shadow banks. Also, transparency, or rather the lack of, has become a bit of a buzzword of late in credit markets. And the reason being, before the GFC, the risk for commercial lending was held within the banks and could easily be monitored and regulated. Now, a growing segment of that riskier loan market is being swept up into private credit funds, which are beyond the view of regulators. And it's this lack of visibility by the regulators which makes it difficult to see where risk bubbles might be occurring. And also rating agencies, Moody's, raised concerns late last year that competition's between the banks and the private credit funds for new deals will likely result in more defaults by corporates. And the reason being that when there's any race to the bottom when it comes to the terms and conditions and the pricing is only going to lead to poorer quality lending.
So it sounds like you've got these large insurance businesses and these retirement schemes that are involved in this now. What are they doing?
Well, some of these investors are starting to voice concerns. When interest rates were at ultra low levels, they were happy to put billions of dollars into these funds purely because of that higher return. But with interest rates having risen steeply over the last couple of years, these investors are growing a little bit nervous that more companies could struggle to meet their debt interest payments as their interest costs balloon, which will obviously potentially result in defaults. But saying that, there are also other investors who are potentially seeing this as an opportunity and are instead waiting on the sidelines to take advantage of any carnage that might happen in the market. And PIMCO is a really good example. So PIMCO in particular have been hiring restructuring experts in anticipation that these stubbornly high interest rates will start to create a bit of strain on corporate America and so have cause strain in the credit markets, and the result being that they will see some great opportunities to buy some very cheap debt. So there seems to be so many potential white swan events out there. You know, we talked about commercial property lending, government deficits previously, and you know, maybe now we should be thinking about adding private credit to that list of white swan events.
What is a white swan event?
Well, it's the opposite to a black swan event, Rick. So a black swan event describes a negative event that is almost impossible to predict, and the name comes from the 2nd century when it was believed that only white swans existed in the world. Therefore, a black swan was something that couldn't exist or was impossible. Then, of course, black swans were discovered in Australia in the 1600s, and that theory went out the window. But the phrase was repopularized by a book written by Nassim Taleb in 2001, where he recoined the phrase black swan events. Therefore, a white swan event is still something with a very negative outcome, but everyone knows about it.
Greg, last time we caught up, we were speaking about your rowing challenge. How's that going?
It was going great, Rick, until I got COVID. And then also went away for a long weekend. So I had 8 consecutive days where I was not on the rowing machine. Even when I got back, I was still struggling to do any and then having to have a bit of a lie down. But I have been catching up of late, so 400,000 meters to go between now and the end of April, and I think that's about an average of 7,400 a day.
Right.
Although we also talked about the 2K challenge at the gym.
Yes. Now, I've seen the results of that. I know you didn't win, but tell us more.
I lost to a 50-year-old. That shouldn't even be in our grade. So
has he just turned 50, has he?
He has.
Ah. He
Yes.
was a long way ahead of any other 50-year-olds.
Yeah, correct. So I think I had a very respectable second.
Great.